Hello, everyone. Thank you for joining this webinar today on HDFC Securities. My name is Vikas Bardia and I work at Smallcase. And today's webinar will be about how you can beat the market with smart beta strategies. Before we start, a quick note, at any point during the webinar, you can send us your questions. And towards the end of the webinar, we'll answer each one of them one by one. Okay, so with that, let's start with smart beta. So what exactly is smart beta? Recent reports, as you guys would have read in the news, a lot of people may have heard this, that there's a lot of debate going on between which is better. Is active management better or is passive management better? There's this very renewed debate that has been happening in the Indian investments scene in the last 2 3 years. And the key difference between these two strategies is that active management usually create the goal of active management is to create portfolios that are different from the benchmark index like the Nifty 50, and they actively aim to beat it. They do so by active stock selection. Fund managers employ a research team to analyze and pick stocks, and as a result there is an increased cost because of which active management is considered to be expensive. Passive management, on the other hand, the objective is to create portfolios that track a benchmark index like Nifty 50, and the objective is also to get very index-like returns. So if Nifty gives you 15%, the passive portfolio that tracks Nifty 50 will also be aiming to give you 15%. As a result, there is no additional expertise here that is required, which needs a research team, which is why these portfolios are also low cost. Now, which one is better, active or passive? Really, there is no one defined answer. But what if you could had both, right? What if you could get active like portfolio management for a fraction of a cost, and which is passive in its implementation? This is what smart beta provides. It is a combination of the best of active management and passive management. That is what smart beta provides. But what exactly is beta? So before we deep dive into understanding what is smart beta, let's first quickly understand what we mean when we say beta. So beta is a measure of risk in finance. Beta is usually a number, uh, and what that number means, the beta of a stock, is that if a benchmark index moves by X, how much does that stock move? So let's say a beta of +2, a company, let's assume that Reliance Industries today has a beta of 2. What that means is every time its benchmark index, which is the Nifty 50, moves by 1 point, this 1%, this stock is expected to move twice of that. Similarly, a beta can also be negative, which basically means that if the Nifty 50 or a benchmark index moves by 5%, that particular stock will move by 5 into multiplied by -2, which is -10%. So beta is basically a ratio that says that if the benchmark index moves by X, that stock will move by X into multiplied by the beta of that stock. Now, one thing to keep in mind is that the beta of the market or the benchmark index is always 1. What do you mean by that? We mean that broadly, if you hear the market has moved by 2%, people are referring to some benchmark index or the other. In case of the large cap markets or the overall market, people often mean that cap 250 index. So whichever index or the market that is being discussed, the beta of that benchmark index is always 1, which is why the beta of a stock is usually a ratio, means that it's a ratio in respect to the benchmark index. Now, one thing to note about any benchmark index is that almost all of these indices are market cap weighted. For example, in the case of Nifty 50, it is an index of the 50 largest stocks on the National Stock Exchange as measured by the market cap of these companies. Stocks that have a higher market cap also have a higher weightage in the index. In fact, as of January 2020, the top 10 stocks in the Nifty 50 have an approximate weightage of 55%. What that means is even if these top 10 stocks are positive and the rest of the 40 stocks are negative, the index will still go up that day because those 10 stocks combined have a higher weightage in that index than the remainder of the 40 stocks. So this is what a normal index looks like, and this is how a normal index is also constructed. But that may not necessarily always be the best way to construct an index or to invest. So what smart beta tries to do is that it aims to redesign the index, and instead of giving market cap as the criteria to assign weights to a stock, they will use smart beta strategies use different weighing schemes. um, let's take the example of volatility. Now, volatility is another measure of risk in finance, and you may have heard that a stock is volatile or less volatile. Now, in a traditional Nifty 50 index, as we just discussed, stocks that have a higher market cap get a higher weightage. But in a smart beta strategy, what is usually done, especially in the case of a low volatility smart beta strategy, we will look at the 50 stocks, and then from that list of 50 stocks, instead of seeing which are the largest stocks first, we will see which are the lowest volatile stocks amongst that 50. Now, let's say Reliance let's again assume that in the previous case, Reliance is the largest company in India, so it has the highest weightage in the Nifty 50 index. But in a low volatility Nifty 50 index, it's not necessary that Reliance will have the highest weightage, even though it has the highest size. In fact, a company which has a smaller size or a smaller market cap will have but has a lower volatility, will have the highest weightage in a low volatility index. So this is what smart beta strategies aim to do. They use the traditional beta, which is calculated using market cap, and then they smartly redesign it. So instead of using market cap and then coming at a index beta, these strategies will define their weightage in a different way. It could be volatility as a criteria, where stocks that are less volatile are given increased weightage. Sometimes the criteria could be dividends, where companies that issue higher dividends are given a higher weightage in the index. It could even be a very simple equal weighted index, where you're saying that, okay, if there are 50 stocks in the index, instead of giving the stock which has the highest market cap, the highest weightage, we will give all stocks an equal weightage. So if there are 50 stocks in the index, then each stock will have a 2% weightage in the portfolio. So this is essentially what smart beta strategies are. They take a ready-made index like a popular benchmark index like a Nifty 50, and then they try to redesign it. Instead of giving the higher weightage to based on market capitalization, they will use different criteria like volatility or quality or dividends to rework the index and create a better portfolio. But why would they do that? So smart beta, essentially any smart beta strategy has one of two objectives. They either look to increase returns for the same level of risk that the existing benchmark index provides, or they will look to give similar returns as the existing benchmark index, but for reduced level of risk. And risk in this context means volatility. So that is essentially what any smart beta strategy aims to achieve. They will take a benchmark index, redesign it using certain criteria that is established by the strategy, whether it's volatility or dividends or quality. And the essential objective to keep in mind is that they will either aim for higher returns for the same level of volatility, or they will aim for similar returns but for much lower risk. So let's take a deeper dive into two such smart beta strategies that is available on HDFC Securities. The first one is low risk smart beta. Now, this actually is also in academic theory is called as the low risk anomaly. It's called an anomaly because high risk and increased risk, and that is usually the case. But academic research has shown that low risk stocks actually provide higher returns for the same level of risk. So, to take a simple math example, let's say one stock has returns of 5% for 1 unit of risk. Another stock has given 10 returns, 10 unit of returns, but for 4 units of risk. Now, in the case of the first stock, the returns per unit of risk is 5 divided by 1, which is 5. In the second case, even though the absolute returns are higher at 10 units of returns, the risk is also higher. So the in this case, the risk level is 4. So the returns per unit of risk is actually 10 divided by 4, which is 2.5. So even though in the second case one gets higher absolute returns, uh, actually in terms of returns for every unit of risk, it is lower. The first stock has given higher returns for the same level of risk. It is a standardization method, the same way people look at percentages to kind of get an idea. So what academic theory has shown is that actually low risk stocks end up giving higher returns per unit of risk and are thus more efficient from a risk return point of view. And that is why it's an anomaly, because traditionally we all believe and have seen that usually higher returns only come with increased risk. But this is an anomaly. That's why it's termed as a low risk anomaly. It's this is also the academic theory that forms the basis of this low risk smart beta portfolio. And this portfolio aims is a smart beta strategy because again what it does is that it looks at the broad benchmark liquid the universe of the top 150 market cap stocks, and from there we create a portfolio of stocks that are not only liquid but are the least volatile, and we weigh them accordingly based on this low volatility criteria. Now, this small case this portfolio gives returns that are similar to Nifty, but the risk associated with them, the volatility associated with that portfolio is much lower. That's why you'll see that the returns for this portfolio will be similar to Nifty, but there will be a lot less volatility in the movement of this portfolio. Uh, as a result of this low volatility screen, what it also helps in achieving is finding companies that are of good quality, and they are not only liquid but they are also performing well. And that's why one of the other things that is really nice about this portfolio is that the dividend yield of this portfolio is almost, I mean, it's 60-70% higher than that of the Nifty 50. So, this company, this portfolio, if you will look into it, you will see very common names that are often associated with blue chip stocks like TCS, Power Grid, and there are 14 such stocks currently that form the low risk smart beta portfolio. This is ideal for people who are looking for long-term investing and they want equity, large cap equity like returns, but they would prefer that it is not as risky as the benchmark index, and this fits beautifully in their portfolio. Another smart beta strategy that is available right now on HDFC Securities is the quality smart beta uh, portfolio. Now, similar to how low risk smart beta strategies give higher weightage to stocks that are less volatile, in quality smart beta, uh, the weighting scheme is such that preference is given to higher weightage is given to those companies that are considered to be of high quality. Now, in order to identify such companies, fundamental criteria like high return on equity or low debt to equity, low accrual ratios are used to build a quality score and identify which of the companies from the top 150 companies that are the most liquid on the NSE, which from them, which are such 20, 15, 20 companies that are highest when it comes to their quality score. They could be smaller than the largest companies, keep in mind, but they will score higher on the quality score, meaning that they are fundamentally considered to be stronger than companies which might even be bigger, but they are not as strong fundamentally. As an additional check, this portfolio also looks at the earnings variability that has happened over the last 5 years in order to identify companies that have been consistently performing well, not just merely in the last 1 2 years, but companies which have remained fundamentally strong over the course of the last 5 years. Ultimately, the stocks that are used here, they are weighted using not only the quality score but also the Sharpe maximization technique, where basically I give higher weightage to stocks that have not only a high return potential but are also less volatile. So it is this sharp this Sharpe maximization uh, portfolio construction method ensures that only such stocks end up going in this portfolio that are not only fundamentally strong but are also considered to be not as risky, which is why the risk level of this portfolio, even though it is more it is going for blue chip stocks and not necessarily less volatile stocks, even then, because of this screening and portfolio construction criteria, the risk level of this small case is actually quite low. And again, similar to the previous smart beta strategy, here also the dividend yield of this particular small case is at least is about 60-70% higher than that of the Nifty 50. Currently, this portfolio has 15 stocks, and people can you can invest in this for a minimum investment amount for 50,000, about 50,000, and you can even start SIPs in this starting from 7,000. So with that, we will conclude today's webinar on smart beta strategies. I hope you guys found this informative and useful. Keep in mind that all smart beta strategies that we have here are only large cap focused. They aim to beat the Nifty 50, and they also provide risk and volatility that is lower than that of the Nifty 50. So do take a look at these portfolios, especially if you're looking to invest in large cap stocks. And with that, we will move on to the questions. Thank you for your time. Okay, so let me now escape from the presentation mode and show you my face so that you all can look at me. Um, let's try and tackle the questions. Let me see the questions that have popped in so that I can answer them. Um, please bear with us as we try and pull up the questions. Okay, so the first question is, how often is the smart beta portfolio adjusted? So this actually varies from one smart beta portfolio to another. Usually speaking, these portfolios are rebalanced every year, but it could also be every 3 months. Now that depends entirely on the portfolio. The reason why it is either 3 months or 1 year is a lot of the financial data in the country is available on a quarterly basis. But for, let's say, the quality smart beta, this portfolio relies on data which is usually available only in annual reports, not in quarterly reports, especially like balance sheet numbers. So these are rebalanced on an annual basis. but the low risk smart beta could be rebalanced on a quarterly basis because it has more availability of data that regularly. Um, The second question is, what is the time period of SIP? Is it 1 year or more? So, investing in a small case portfolio actually gives you the flexibility to have SIPs with frequency as little as every week to even going every quarter. So, you could have an SIP that goes every week, every 2 weeks, every month, or every quarter. Now, how it is recommended in general that the longer you keep doing SIPs, the better it is for your long-term growth of long-term portfolio growth. So there is no one right answer saying that you should do an SIP only for 1 year or only for 2 years. You have the ability to do an SIP very frequently, and all financial learning generally points to the fact that the longer you can keep your SIP going, the better it is for your portfolio's long-term growth. All right. More questions coming in. So one of the questions asked by Mr. Mohan is, are the stocks dynamic or subject to change frequently? Yes, sir, they are. They are subject to, as we were discussing, they are subject to change either every quarter or annually once. The next question is from Mr. Kishore. What should be the ideal period for holding quality smart beta? So it's difficult to say that there is a fixed ideal time period. Uh, generally speaking, these portfolios should be held at least somewhere between 1 to 3 years for the long term, because these strategies are long term in general. They do take time to play out. You may not see returns instantly. So at least 1 to 3 years is an ideal time period to hold it. That said, I mean, since the portfolio is rebalanced very frequently, there's no risk of holding an outdated portfolio that doesn't meet the criteria of that portfolio. Professionals are constantly looking at this and rebalancing the stocks in it. So, you are well, if you holding it for longer than 3 years, obviously will yield better results. That is true for all investments in general. But at the very least, at least 1 to 3 years would be a good time to give yourself and the portfolio to play out, for the strategy to play out. Okay. Another question that has come in is, how to find beta stocks. So honestly speaking, beta is there could be low beta stocks, there could be high beta stocks. You can find this data on the NSE website as well as on third party providers. This is one of the very basic information that is there that accompanies any stock wherever you are searching for it. So depending on whether you're looking for low beta stocks or you're looking for high beta stocks, you can find them accordingly. But keep in mind, you know, high beta stocks do bring in the higher potential for returns, but they also bring in additional risk and volatility. Okay, let me see if there are other questions that have come in. All right. Which Another question that has come in is, which strategy is appropriate for smart beta, lump sum or SIP? And this is coming from Mr. Bharat. Honestly speaking, sir, both lump sum or SIP, they serve different purposes. SIPs are great if you don't have the time to actively look at the markets, or you can just do it once and then forget about it. So they serve a different purpose. For smart beta, you could be doing both, and depending on how much capital you have to spare, you could choose for one or the other. This is true for all strategies, including for quality smart beta. Next question that has come in is that, Is it possible? Can we have our own basket of smart beta stocks, or do we have to follow only your recommended stocks? So you can obviously have your own core basket of stocks. The challenge, and from personally speaking, the challenge that most investors find in finding stocks which meet the smart beta requirements is that it requires a lot of modeling, a lot of building out the strategy, and then continuously monitoring the stocks. So while we do recommend that you follow the stocks that are there in the portfolio and rebalance the portfolio accordingly, as and when the research team gives additional updates to you. Ultimately, you do have the power and the ability to include or exclude any of the stocks that you feel either meet or don't meet the criteria. So you have the ability to customize even this smart beta portfolio. But we obviously recommend that you do not. And also, if you are doing it, keep in mind that you are following the smart beta strategy completely, in order to keep consistency in your portfolio and for the best results. Another question that has come in is, um, someone has asked the question that they already have a portfolio, existing portfolio, in which there are, let's say, 30 40 stocks. A lot of the stocks that they have in this portfolio are also in the quality smart beta portfolio or low risk smart beta portfolio. Now, is they're asking, would it be possible to transfer these from their existing, in their from their portfolio to this smart beta portfolio? Now, unfortunately, it's not possible to transfer these. What is possible is that if you want to see how this strategy is performing as a small case, as a portfolio, then you may, if you want to track it in that one place as a smart beta portfolio or strategy, you may sell it from your existing holding and buy it similarly again. Alternatively, you can write to support and see if there is a way for this to be reconciled from the backend. That would be the best way actually to see whether or not this is possible. So I think uh, that pretty much covers all the questions. I hope all the questions were answered, and they were answered in a way that you are not left with any further questions. However, in case any question was missed, or if you still have any further additional questions, please do write to us or reach out to your RM, and we will get back to you with answers as soon as possible. Thank you again, everyone, for your time and for tuning into this Smart Beta Small Cases webinar on HDFC Securities. Have a wonderful evening, and thanks again.